My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'm Bill, make friends. I'm just trying to make you a little money. My job is not just to entertain, but to put it all in context. So call me, 1-800-743-CBC. Tweet me at Jim Cramer. Maybe there's nothing can be done. Maybe it's a hopeless situation. Or it's a situation where someone can figure things out, fix them. But they have to come out of retirement or have experience that they don't need to be taught. They just happen to have another job elsewhere. Sure, the average had a good run today. Dow gaining 243 points. S&P advancing 0.38%. NASDAQ up just 0.03%. But so many big-name companies are struggling here. And I found myself wondering which ones can be saved and have their stocks go higher and which ones can't. Look at what happened with Starbucks. Really is. This is an amazing business story. I've got to tell you. Here's a stock that had been in free fall, but all it took was bring in one person, a talented food executive, a CEO, and then it soars. The new guy, Brian Niccol, is a genius at what he does. He turned around Chipotle, which it's hard to believe it was ever struggling now. But it's not like his predecessor, Laxman Narasimhan, was a knucklehead. Laxman was beloved at McKinsey, beloved at PepsiCo, and beloved at Reckitt Benckiser, where he was the CEO. When he took over Starbucks, all I heard was he'd worked in snacks and beverages and packaged goods, and he really understood the process. He was supposed to be the logical, considered choice. Now, I don't know what the heck happened between then and now, but ultimately it became clear that Starbucks was a great company with loyal customers and not so hot management. Niccol, the new CEO, might have to take a page from Ron Shaich, the former CEO of Panera Bread, who had to develop a whole new model for stores because the old locations were slow, unappealing, expensive, couldn't handle mobile ordering. Hey, you know what? That's the exact problems that Starbucks is dealing with. It worked for Shaich with Panera 2.0. Maybe it can work for Starbucks with the novel 2.0 tested and ready to roll. Maybe we got to roll it out in another city. I don't know, but it can happen. But of course, the old CEO, Laxman, he didn't want to do that. He thought he had all the answers. Behind the scenes now, many are blaming founder and former CEO Howard Schultz for lording over his successor. I think Howard was more appalled by the lack of contrition than he was by the horrendous execution, which he did not like. But if you're blaming Schultz for firing Laxman, maybe you should thank him, because he just created $20 billion in value when we learned that they poached a brilliant CEO from Chipotle. $20 billion of wealth creation one day. Hey, I'd like to take credit for that. We all take credit for it. If we're looking for what can be saved, you need a big change at the top. Starbucks is going to become the model. So now let's talk about love. No, not love. Love, L-U-V, Southwest Airlines. Today we saw the slate of 10 potential directors from the activist investor Elliott Management. They want to bring in these 10 to replace 10 on the board. Well, of course, everything would change if they did that. Every one of Elliott's nominees excels in the fields that Southwest needs: technology, revenue management, safety, government. On the other hand, if left to its own devices, I bet Southwest keeps going lower. There's still time for the board to accept their lack of diligence and move on with their heads high. But I'm definitely betting on Elliott here because his people are better and they will get a better CEO. Starbucks. Let me give you another one. Disney. Now, this one's salvageable. We know Nelson Peltz, another famous activist and shareholder, wanted to join the board. Management spent a fortune keeping him off because apparently they couldn't stand the guy. Disney stock went from the 80s to 123 on Peltz's involvement, but ever since he lost, what do I need to tell you? Fell back to 86. What does that say? Yet this is a company that dozens of brilliant execs would like to have a shot at running. To me, Disney's worth holding because it's simply got so much valuable franchises like Starbucks. It's hard to destroy no matter how hard management tries. You just need the right team, and it's a winner. You need a change agent as CEO, not just as a director. And in the case of Southwest, maybe you do need to change up the whole darn board. Now, let's take a look at another while we're going over these things. Let's talk about Nike. I think it's time we have to come to terms with the idea that something may be very wrong with Nike. Otherwise, how do you explain the stock's plunge from 122 to 78? Now, we've seen a resurgence in New Balance, an uptick in Hoka, some startling positive numbers from On Holdings. Adidas has made a real comeback. Nike, not so much. And I'm being very polite. Maybe there's nothing that can be done. But CEO John Jono, consultant background, by the way, just like Laxman Narasimhan, who got booted from Starbucks. Then he went to work at PayPal and run ServiceNow before going to Nike. I mean, these two management consultants have something else in common. They always have said and agreed that they're doing a great job, even when the stocks say the opposite. Look, if you've read Shoe Dog by Nike founder Phil Knight, which is fantastic, I can tell you that Donner is no shoe dog. The stock stood at 101 when he started as CEO in January of 2020. It's now at 78. That does not seem like value creation to me. People would take their Nikes off and walk on hot coals to get that CEO job. Maybe there is someone who can do something better. A Brian Nichol of shoes? Don't you think there has to be one? Now, after the close, we learned that Bill Atkins, Pershing Square, took a stake in Nike, according to the 13F. We have no idea of his intentions. Maybe just recognized a salvageable situation. He wants to make money. Maybe he has already sold it. Who knows? But we do know that Ackman has been an activist, and this stock sorely needs one. Someone has to say the truth. All right, how about a former Dow stock? Walgreens. This is a totally different story. Right now, it's being run by Tim Wentworth, and it's being run into the ground. But you know what? I can't blame him. Walgreens has been a slow-motion train wreck for ages. I thought this chain was doomed from the day Amazon put same-day delivery into motion for thousands of things you used to get at the drugstore. But unlike Nike or even Southwest, the damage at Walgreens may be so great that a turnaround is impossible. I do believe in Tim Wentworth. If there is a possibility of a turnaround, he will do it. I just don't know. How about Intel? Picking all these big stocks. The chip maker is overextended and losing share in its major product lines. It just sold one of its best assets, which happened to be 1.18 million shares of ARM Holdings. Yeah, really, that's what it comes down to. Intel's building plants all over the place, and its CEO, Pat Gelsinger, seems to believe that he, too, like John Donahoe, like Luxman Narasimhan, is doing a great job. Yeah, it is reminiscent of the CEOs of Starbucks and Nike. Intel did do something shrewd, though. It brought in two savvy firms, Brookfield and Apollo, as construction partners. My advice, the people who run Brookfield and Apollo, you people should take a crash course on how to actually make and sell semiconductors, because looking at Intel's current trajectory, you're going to be doing a lot of that. Finally, can Boeing be saved? If there were 5 aircraft makers in this world, then I would think Boeing would have been done for and out. But there are only two companies that make large commercial aircraft, which means these guys can afford to make endless mistakes, and they've taken advantage of that. I think Boeing's like the old GE right now, a company that can make it, but it'll take a lot of really good work and great execution. From what I can tell, this new CEO, Kelly Ortberg, may actually be up to the task. I was going to suggest that he move the headquarters to Washington where he make the planes. The fact the previous CEO hadn't done it was a sin. But, of course, he's already done this. It's going to take a lot of time to turn around Boeing. I think it's probably too soon to buy the stock, given the balance sheet so hideous. But Ortberg has horse sense. He was considered an excellent exec at Rockwell Collins, a maker of aerospace components. Given this is a duopoly where America needs Boeing to do well, I bet he does pull it off. It's just not the time to buy it. Look, we can bemoan companies that can't shoot straight. Or we can look at what Larry Culp did when he came in and saved GE from collapse. We can see the immediate faith of marketplaces and Brian Nichol to turn around Starbucks. This can be done. The companies have to stop fighting it, though. Here's the bottom line. Right now, it looks like, other than Boeing, the board seem pretty happy with how things are going at these companies. Maybe a staffer put the stock chart page upside down in the board pack, and the directors are pleasantly surprised. Or maybe the CEOs and many board members simply don't own much stock and they just don't feel the pain. Otherwise, I can't imagine how they can just sit there and accept the status quo, because, frankly, in each case, you and I both know it is simply unacceptable. Let's go to Jason in Connecticut. Jason.
Mr. Cramer, big booyah from Jason in Connecticut. How are you, sir?
Good to hear from you, Jason in Connecticut. What's happening?
Hey, I'm a longtime follower and club member here. Thanks for all you do for the investing community, Jim.
I hope you like the call today. I graded some of those guys pretty hard. You know that. Graded some hard. Yeah.
We appreciate all you do. Hey, Jim, my question is on Chevron. I'm a longtime shareholder. The stock's been good to me, and it pays an excellent dividend. Should I pick up some more shares at this level? Thanks, Jim.
I think that Chevron is a buy. I think they do a great job. I think that Mike Wirth is terrific, and I think that you should pick some up. This is a nice level with a 4.5% yield and buying back a lot of stock. I think it's terrific. Let's go to Alfred in Virginia, please. Alfred.
Hi, Jim. Thanks for taking my call. I'm down 30% on my position on Etsy. Should I buy more, sell, or hold? Thanks again.
Oh, my. Okay, this is such a hard one because I think Etsy is such a great. It's one of those companies where I buy so much stuff from them. Many other people do, but that doesn't cut it. I think you're going to have to understand that if you're willing to buy time for a while, that's what you're going to have to do with Etsy, because it's not going to go right back up. It's just not. Let's go to Peter in Maryland. Peter.
Jim, Peter calling from Baltimore. I got my mom all over me on this Occidental Petroleum stock. She should let up. Me that the Oracle of Omaha is all in on it also, so would love to get your 2 cents.
Well, it's good. I mean, Oxy's good. It's not my favorite. It's come down a lot, but that's because it's an oil company. I don't like the yield. I don't like the balance sheet. I like Chevron much more. I like Diamondback much more. And, of course, I like Coterra much more. It's just a given that I think every one of those is superior to this company. At the same time, if Warren Buffett owns it, even if it's like Ulta, if he buys Ulta, the stock goes up 10%. I mean, one day this stuff is not going to be like this. But right now, you're dealing with Buffett versus Chevron. I want to take Chevron, but the world wants to take Buffett. Look, maybe these CEOs and board members don't own much of their own stock. Otherwise, I can't imagine how they can just sit there and take this kind of pain. On my money tonight, take 2 shares have underperformed so far this year. Is it game on or game over when it comes to an investment in the company? I'm talking with its CEO. And a chill overtook Chili parent Brinker International today. Yeah, eat. Stock tumbled 10% after earnings. What's behind the drop? And is it Chili's fault? I'm going to the CEO. But first, Home Depot just offered a clear sign of what's to come with housing and the Fed. I'll reveal it and what it means for your money. So just stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Eureka! I found it. Buried within the Home Depot conference call yesterday was the most perfect analysis of what can happen to housing if the Fed decides to be our friend and starts cutting rates. Let me share it with you because right now this is incredibly important. It looks like the magic number is 6.5%. That's the mortgage rate where it all seems to come together. That's where, according to Home Depot CEO Ted Decker, quote, you saw an immediate increase in housing activity, mortgage applications, mortgage refi applications, and then unfortunately the rate spiked back up to, I think, almost to 7%, end quote. You could read much of Home Depot's conference call as a plea for lower rates, punctuated by the positive acquisition of SRS last March for $18.25 billion. SRS is a professional building supply outfit, specializes in pools, landscaping, especially roofing. I think Home Depot bought SRS to try to get off this darn mortgage rate treadmill, and I do not blame them. It seems like so much spending on new homes, remodeling, and renovation is controlled by that rate, either through mortgages or home equity loans. Plus, SRS is taking share, which is what you need when your core market isn't growing much. Home Depot paid a great deal for it, but I think it's worth the price given how much it can expand their total addressable market. The connection between mortgage rates and Home Depot's business has, I think, honestly, and I've followed this company for years, I don't know it's ever been this tight. As CFO Richard McPhail told us, quote, components of the large project kitchen, bath, flooring, and lighting are all under pressure, and our customers tell us it's because that large project is being deferred, end quote. That's huge. It's being deferred because of the rates. That's what I want the Fed to pay attention to. As McPhail explains, quote, there is certainly a direct relationship between decreases in mortgage rates and the amount of activity that you at least see picking up in turnover, end quote. All right, that seems natural to me, but some analysts argue that even if the Fed cuts rates, it simply won't matter. Because we have such a severe housing shortage in this country, and the home builders haven't been too eager to add new capacity. Meanwhile, existing homeowners are reluctant to sell because they don't want to lose that cheap mortgage rate that they got during the age of near zero interest rates. It seems like it's a box you can't get out of. However, if mortgage rates were to come down close to that 6.5% number for the 30-year fix, I say we'd see way more remodeling and restoration work bolstered by home equity loans. These are all areas that got caught in supply chain disasters during COVID that never really boomed in post-COVID world because the Fed rapidly raised rates in 2022. Lower rates would really help this R&R business. Don't take it from me. Again, Ted Decker says point blank, quote, consumers have seen their home values go up 50% in the last 4 years. Their home equity has increased almost 70% since right before the pandemic. But there's been pressure on larger products tied to construction, end quote. That's in part because housing turnover is down some 40%. Decker goes on to say, quote, everyone's expecting rates are going to fall, so we're deferring those projects, end quote. So in other words, we all believe the Fed's going to cut. Let's not do a thing until the Fed cuts. And that's why we have this downturn. On top of that, Decker notes that, quote, there's just a lot of noise with political and geopolitical environment. Unemployment ticked up. Inflation keeps eating all at disposable income. And I think people just took a pause as we progress through the quarter, end quote. That's exactly what Amazon said, but nobody seemed to in mind when we heard the same story from Home Depot, because we all think that the customers will come right back the moment the Fed starts cutting rates. That's not just from people taking out home equity loans to remodel. Management also talked about the so-called golden handcuffs, where people got mortgages at 3 to 5% when rates were much lower, and now they refuse to sell their homes. And perhaps really the smartest moment of the whole call, and it's a great call, Decker explained that what he called golden handcuffs problem will only last 1 or 2 years thanks to, and then here's some good news, quote, family size increases, household formation moves for employment and retirement, end quote. In other words, much of the housing chain is simply stalled by a lack of turnover, but the golden handcuffs cannot last forever. Those people will move with lower rates. Consumers will take out more home equity loans with lower rates. We did have some lift. Refi surged 35% in 1 week because rates hit their lowest level in over a year. Again, it demonstrates what happens when rates come down, but it's too ephemeral to base things on 1 week of rate declines. The Federal Reserve is making things too tough right now by not cutting rates to keep that momentum going. I think they've now done enough to slay inflation, even as the cost of shelter is still high, as we saw from the components in CPI this morning. In the end, though, Home Depot call gave me hope. Give me hope that we can avoid a hard landing for housing, but only if the Fed unlocks those golden handcuffs that it created by taking rates to super low levels a few years ago. I bet that's what happens, and clearly Home Depot agrees, or else they wouldn't have shelled out $18 billion for a professional roof and pool supplier, two areas that desperately need lower rates. So here's the bottom line. Right now, housing is waiting for the cavalry to come to the rescue, by which I mean it's waiting for the Fed to cut rates. While that's not something we desperately need, at least for the moment, it could be a major positive catalyst for a huge part of the economy. Yes, lower rates will work, but alas, not until the Fed gets off the bench and gives them to us. Let's go to Charles in Arizona. Charles.
Greetings to CNBC's finest there.
Oh, thank you, Charles. How can I help you?
I just want to mention a couple of weeks ago, a caller from Florida insulted your Phillies on air. How dare he comes into your house like that?
Yeah, I was going to put him down like a dog, but I like dogs. So go ahead.
All right, Jim, I'm an American Express card holder, and I want to be a shareholder. Is now the time to wait? Is it time now?
I think
or
it's a terrific time to buy American Express. All that's going to happen is you got a Fed rate cut coming. I don't know about the black card. I've been trying to assess the advantages of that. It seems like it's cool, but I don't. What do I care? But I do think that this is a good time. The stock should be up more than it is. I love that last quarter. Everyone hated it, and they were wrong. Let's go to Alejandro in New York. Alejandro.
Hey, Jim. I'd like to get your thoughts on Airbnb. I got a buddy who's got 40% of his portfolio in this thing, and I'm wondering if it's time for him and for others to part ways, given the weak guidance they provided during their most recent earnings call.
Well, 40%, that gentleman does not have horse sense. You can't do that. The Airbnb call was not a good call. And it wasn't a good call because they didn't want it to be a good call. It was not us. It was not me making a determination, well, you got to avoid Airbnb. It was the company making a determination that things aren't as good as we thought. And the travel's not as good. And I even think about hotels are too expensive. But Airbnb, I have to see that the stock has to go lower before I can recommend it because I was so shocked at how negative Brian Chesky was on the call. And he's the CEO, so he certainly knows more than I do. Home Depot's conference call told me that the housing market is simply waiting for the Fed to rescue it by cutting rates. I think when they do, we can avoid a hard landing for housing. Right now, we need housing back. We don't have it. Bad Money is back after the break.
Coming up, rising costs took a bite out of earnings. Is this restaurant stock still on the menu? Hear the specials next.
All right, what the heck happened to Cramer fave Brinker stock today? That's the parent of Chili's and Maggiano's. I thought this was one of the few restaurant chains that was working in the world where the consumer's rebelling against high prices. But after the company reported this morning, the stock plunged more than 10%. What went wrong? Not clear. The earnings are only getting hit because the company's investing heavily in labor and facilities in order to improve the guest experience. They don't have a pricing problem. They don't have a traffic problem. Traffic was actually up big at Chili's. Same-store sales were amazing. I think this is a stock that was up big going into the quarter where shareholders were looking for an excuse to ring the register. If these new investments can keep fueling the company's growth, that sounds good to me. Let's check in with Kevin Hochman, the president and CEO of Brinker International, to dig deeper into the quarter. Mr. Hochman, welcome back to Bad Money.
Hey, thanks for having me on, Jim.
Okay, so we do need your help because I see someone who has made a tremendous success of a chain that I didn't really think that much of, with great same-store sales, most important metric. And what you want to do is continue that momentum going. But in order to do that, you need to spend a little money. What's the matter with that analysis?
So we had a great quarter. I mean, we outpaced the industry by 16 points on sales, that's kind of like video game numbers. And
right.
We did it through incredible value with great service in a fun and friendly environment. And those are the fundamentals of casual dining. And every quarter we keep getting stronger and stronger. I think what happened today was we pulled forward some investments. Number one, we wanted to have a little bit more labor in the restaurants when we had this influx of guests that came in to make sure they had a great experience. Most of those guests were actually first-time people to Chili's, so we need to make sure it's a great experience, and it was. Our guest metrics did not suffer. Typically that happens when you have big traffic bursts. And then the second thing is we pulled forward some facilities investments. We saw the opportunity, given how well we were doing in the quarter, we pulled those forward. And I think that's what happened. I think the Wall Street expected a certain level of flow-through on those incremental sales. We reinvested it back in the business, and that's where we are. But we are very much on the trajectory that we want to be.
All right, let's compare this for a moment to Starbucks. Now, Starbucks got the big influx, but they did nothing. They didn't add people in the back. They didn't fix the facilities. Next thing you know, you're in a long line. Next thing you know, you hate Starbucks. I can't believe that all restaurants, I have to believe all restaurants are the same. If I start going to see a big line at your place, I'm going to another place. To avoid that, you need to make some changes that are positive.
Yeah, that's exactly right. We've been at this for almost 2 years now, where we're making investments in labor. We're simplifying the restaurants so that there's less things for them to do so they can win with the guests. We've hit over 22% of our menu since we started this journey, right? And then we're improving the facilities. And the whole idea is we've been beating the industry for 18 months now. This was even a better quarter. And it's just another stair step in our turnaround, and it's happening. It's real.
So if you had done nothing, you as an expert in this business have to believe that 2-3 years from now, that's going to come back to haunt you if you did nothing.
Well, it'll be sooner than that, right? Because if we have new guests that come in and they don't have a good experience, they're not going to come back. We're not going to sustainably grow the business. We don't want to have 2 or 3 years of record growth and record profits. We want to have a dynasty, and that's what we're investing for.
Now, I am looking at the making of a dynasty right here. This is not a cheeseburger, fries, Diet Coke, and then you got to have it in a little bag and you hope it in the car. You don't want to spill the ketchup on yourself. This is a sit-down meal for a similar price.
Well, that's exactly it. So you got a half-pound burger, you got fries, you got unlimited chips and salsa, and an unlimited soft drink, and it's at $10.99. We continue to say it's an unbeatable value. When you see it all together like this, you realize it's unbeatable value, and that's what the guest is saying. This is an unbeatable value, and that's why we're really schooling the industry right now by double digits, and I think it's going to continue because we're doing all the right things.
All right, so how many more units can you put up if you figure it out?
Well, right now we're focused on investing in our current facility.
I know, but I think that I would, if I were you, I perfected the formula. It's time to start putting them up.
Well, we build anywhere from 10 to 15 a year.
You know what I'm thinking.
But you're thinking accelerate, and I think we got to continue to focus on the core. I think we cannot get bored of the fundamentals. Coach K used to say, if you do the fundamentals so well, that could be your competitive advantage, and that's exactly what's going on with our brand right now.
Okay, talk to me about how you got a same-store sales number with everyone else. I mean, people have to understand Chipotle has a great same-store sales number. Yours is better. How?
Well, it's the fundamentals, right? I mean, you talk about when the macro gets a little soft, and we know guests are going to pull back on their trips.
Right.
They're going to choose the places that, one, have superior value, and two, they know they can trust. They know they can have a great experience, because when you're making less trips, you don't want to go to a place and, hey, I might have a great experience. You're going to go to the places that you know you're going to have a great experience, and that's the reputation we're now getting in the industry.
Now, in the industry, you also are getting a reputation for knowing how to market drinks. There are many large companies, including some major liquor companies, that somehow think that their brand is more important than your drink. You have broken that mold. I don't know the tequila you're putting in, but it tastes every bit as good because it's a Blanco and they're all the same anyway.
Yeah, well, we do use great branded drinks, though.
Right.
So, and we have all the different segments covered. So you can go to a $6 margarita of the month. Our current one is it's a Mango Mamba. It's got El Jimador. It's got Triple Sec. It's got Fresh Sour. You can get that for just $6. I mean, that's unbeatable.
Why isn't that not? Why? How come you? I found it unbelievable. It's a $12 drink everywhere in this country. But you're willing to, make less? Or is it just...
Absolutely not. We have what's called the barbell pricing strategy.
Okay, tell me.
you got to meet guests where they are. Some guests want great tequila. They want it at a great price point, right? And they want it to taste great. And we have that with the $6 margarita of the month. Other guests want something maybe a little smoother, a little more super premium. We got the Casamigos, we got the Termado Blanco. And those things are obviously a lot more than $6. Well, we don't just sell the $6 margaritas, we sell all the margaritas. And if you want something more premium, that really rounds it out for us. So we're able to make a lot of money on alcohol, a lot of money on drinks because we have a barbell strategy. And we're doing that with all the core 4 segments. For that entry point, price point guest that needs just a low price, we have that. You can go all the way up to pretty much whatever you want in our restaurant.
Okay, now, a lot of attention on TikTok, Triple Dipper advertising, secret Nashville hot mozzarella sticks, but football starts in 5 weeks.
Yeah.
Are we going to see major presence in football, NFL?
Well, I wouldn't call it a major presence, Jim, but we are certainly going to have all the games on Sunday Ticket. We obviously have amazing food to watch the games, and we create an environment that people want to come to watch games with us. So, are we going to be a sports bar per se? No, but are we going to have amazing food at a great price point, and you can come watch your sports? Absolutely, and I think we're ready for it.
Well, look, I'm glad you cleared everything up. There are a lot of people who felt that they look at the stock. Honestly, they look at the stock and say, "Oh, something's wrong." They never think, wow, investing for the future is what they have to do. New year, it's going to be amazing. And that's what I think is going on with Brinker.
That's exactly right. We don't want 2 years of amazing stock price performance. We want a dynasty, and that's what's happening right now.
And we've seen the 2 year and off. You and I have seen that many a time because people were afraid to take a hit.
That's right.
And you weren't. That's terrific. That's Kevin Hochman, President and CEO of Brinker International. Not only is nothing wrong, what's happening is right. Mad Money's back after the break.
Coming up, more than a game, Cramer's got the fun-making stock that plays by its own rules. Next.
We know the video game industry's been through a wild ride. Many gaming stocks have stalled out in 2024. And I'm wondering if the dynamics of this business have changed over the last 5 years. I don't know. Consider the case of Take-Two Interactive, best known for Grand Theft Auto, one of the largest entertainment franchises in any medium. Let's just call it the largest ever, because that's true, okay? It's also got Red Dead Redemption, various consistent sports games under the 2K banner, and a growing portfolio of very successful mobile games. After a nice run last year, and in the early part of this year, the stock ran out of steam. It rolled over. It's now down 10% for 2024. S&P's up 14% for the same period. So what gives here? What is the street doing wrong and not realizing? Because I got to tell you this, they always seem to care about Take-Two's of whether Grand Theft Auto is on track. Nothing else seems to move the needle. In fact, when the company reported last week, even though their net bookings and earnings came in a tad light, stock rallied 4% because they didn't delay Grand Theft Auto 6. I don't know. What else does Take-Two have going for it? I think a lot. But let's go straight to the source of Strauss Zelnick, the chairman and CEO of Take-Two Interactive, to get a better sense of the quarter and what comes next. Now, Strauss, if I'm frustrated, it must drive you crazy. But you're non-promotional, which I love. So could you clinically tell me what the company is made up of right now so we can kind of figure out what that's worth rather than what happens in the future?
Well, look, first of all, it's nice to be here, Jim, and nice to see you.
Yes, it is. I'm sorry.
And thank you so much.
I'm frustrated.
I'm not frustrated.
All right.
Really, look, I'm thrilled. We are today the number 2 pure play interactive entertainment company. We'll have about $5.5 billion in net bookings this year. We're a highly profitable business. And look, we do have Grand Theft Auto, which is the biggest entertainment property of all time. And we're thrilled that Rockstar Games is part of our network and that Rockstar Games is bringing us Grand Theft Auto 6. How could we not be thrilled? Right. 50% of our net bookings come from mobile. And Zynga, our mobile company, is showing that it is a bigger and better hit creator than anyone else in the business. In the last year, we've delivered Match Factory, a massive hit from our label Peak.
Top hit. Top hit.
We have Star Wars Hunters. We have recently launched Game of Thrones Legends. We have a title you haven't heard of called Screw Jam, which is another huge hit. Toon Blast, which has been around for 7 years and is still meaningfully up in the last period. Now, we don't have the biggest mobile title right now, but we have a bigger collection of new hits than anyone else.
Right. So the acquisition worked. The Zynga acquisition,
it's highly accretive.
It worked. Highly accretive. So let me tell you what I was thinking. I happened to go over this, and people at home don't know this. I happened to go over your release before, which I'm embargoed, so I don't do anything. I can't talk about it. And I thought the stock would be up 10. Okay, I just did because not only is Grand Theft Auto on time, but these Zynga's it's just so lucrative, it's amazing. And other things, and NBA 2K is good, and you've got a bunch of other things that we got. Sid Meier, which matters, that a lot of guys play in the office. And I come back and I say, well, how could I have been so wrong? Humor me. I'm thinking that there is a myopic group of people who focus on only one title, but that's because it's the biggest title of all time. And nothing else can move the needle against the biggest title of all time. Is that a possible analysis of why the stock's being incorrectly valued?
I think there are times when we've been seen as only Grand Theft Auto. But remember, Grand Theft Auto was 15% of our revenues last year. 85% was our catalog, our other new titles, NBA 2K and the like. We're thrilled that we have that title. We have a lot of other things going on. The truth is, though, Jim, you know this. If the markets were always efficient, there'd be no buying opportunity.
True, but I'm talking about a company that may turn out to be selling at the lowest multiple other than Ford and GM when this title comes out.
Well, we feel really good about the position that we're in. And of course, you know, our view is we go do our work. We never take anything for granted. Right. It's our job to create the biggest hits in the business. We now have 11 franchises that have each sold at least 5 million units with one release. And a title that we don't really talk about that often is Red Dead Redemption.
Right.
Red Dead 2 sold 65 million units. That's bigger than virtually anything else in the market, aside from Grand Theft Auto.
Okay, so how big really is the digital advertising market? Maybe we're looking at that wrong. Maybe that can be far bigger than we realize.
Oh, that's a very significant part of our business on the mobile side. And we're really excited. I mentioned Screwjam. We have another title called Twisted Tangle. These come from a studio called Rollick that used to be in the hyper-casual business, which only was ad-supported, and now is in the hybrid casual business, where we have in-app purchases and advertising, and that business is booming for us.
Okay, now on Grand Theft Auto 6, let's just go there. The technology that Jensen Huang, the NVIDIA technology, is so great that I have to believe this will be something that is a giant step function higher versus all the others. So what do? Do you just, you don't really need to do anything, Strauss. That's what's so nutty. You can just wait for that to come out with this stream of income that the other games generate. I know you always want to innovate. I know you're constantly doing that. But again, this is the biggest problem I had if I were you, which is, are you seeing what numbers we're going to put up?
You know, waiting isn't really part of my program.
I know.
So we have a three-part strategy. Try to be the most creative, the most innovative, and the most efficient.
Right.
We obviously have really high hopes for Grand Theft Auto.
Right.
I would note that Grand Theft Auto 5 crossed over 3 generations and remained both the technical and creative standard bearer after the 3rd generation. It's been 13 years since that title was released, and it sold in over 200 million units. It continues to sell every quarter. So if history's any guide, 6 should be just amazing. At the same time, as you mentioned, we have NBA 2K, we have WWE 2K, we just bought Gearbox, so we have Borderlands, it's an amazing franchise. Civilization, we just launched a mobile version of Civilization in China in partnership with Tencent. That's huge. There's a lot of other things that are going on at the company.
Okay, so, all right, well, let's go there with the movie. The movie was not that successful.
No, it was not. It was a disappointment.
Right.
Interestingly, it moved the dial on Borderlands catalog sales despite that, which was kind of amazing. Yeah.
The movie was not
right, we were criticized for the movie. Now, remember, we had no financial
You had no
exposure.
financial stake. That's really important. This was kind of like when Every Nun Cries, and, you know, the Mattel movie comes out, and I'm blasting him, why don't you own more of it? And he's saying, well, look, you know, that's not the way it works. Well, this isn't why it shouldn't be the way it works.
Business. We don't want to be exposed to that business.
That's not your job.
However, it is pretty amazing that we got a marketing halo from the movie, even though the movie was seen as a disappointment. By the way, we and the team worked really hard on it.
Right. Okay, so let's, if you don't mind, let me sum it up. I think that the rest of the company is worth a great deal more than people think, because if it's only being valued for the large part for Grand Theft Auto 6, then you get all these other things for free, and that's the only way I can come up with this, Strauss. You get them for free. It doesn't mean that they should be. Maybe people think they should be free. It's hard to imagine, given the cash flow, that they should be valued at free.
Tend to agree with you, Jim.
Well,
let's see what the market does.
That would say that I would buy every share I could when I got get a lot more cash in from Grand Theft Auto. I find it frustrating because you are doing such a great job.
Oh, thank you.
And you know, sometimes life's frustrating.
We have an amazing team, and you know, we got a lot more work to do.
Fair enough. Okay, that's Strauss Zelnick, Chairman and CEO of Take-Two Interactive. You just saw a discussion about how to try to value something that is worth a lot more than it's selling. Not about how to promote, not about how to push, but just how to value. That money's back there.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. Some of the lightning round quick for Ralph Goldman. You send the touchdown. Buy, sell, solution. No, of course, what's that? Much temporary display. But play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. We'll start with Tom in New York. Tom.
Jim, good evening.
Good evening, Tom.
Good meeting today, Jim. Much better than last month, right?
All right, let's make some money. What's up?
Okay, listen, Jim, my question for you is on Global Foundries.
I don't like the foundry business as much. It turns out that the only people who really know how to make them cheaply is Taiwan Semi. So if you want to own a foundry, Taiwan Semi is the one to do it. Let's go to Bill in Connecticut. Bill.
Hey, Jim, thank you for taking my phone call.
My pleasure.
The stock that I'm talking about is stock symbol S, Sentinel One.
You know what? I had not been a believer in S. He's coming after that guy. Tomer's really coming after George Kurtz. Holy cow. But I do think Sentinel's picking up some business. So therefore, I'm going to tell you that I actually support it only for a trade. Matt in Ohio. Matt.
Hey, Jim. Thanks for taking my call.
Sure.
I've had this stock for a little while, the one that I'm calling about tonight. It's done well over the last 2 months. It got hit pretty hard after hours trading today. It needs some guidance. Clorox, call signal CLX.
Okay, so Linda Rendell has done a remarkable job. Let's understand that. She did not get a good hand. She was not delivered a good hand. I do believe that she's doing it. How about the way she covered from that incredible cyber attack? She was right there. And I like the fact that she wrote off the vitamin supplements. They were losing a fortune. That was a bad hand, too. I like her. I'm a buyer, Clorox. Bye. Let's go to Dave in Iowa. Dave.
Hey, Jim. Booyah from Northwest Iowa.
Okay, I love Northwest Iowa. What's happening?
Hey, 10 years ago, I purchased a couple hundred shares of Altria from my Roth. Shares have doubled. Price has almost tripled in value. Trim it, and where would you put it for a dividend high flyer, please?
All right, this is so hard. Look, I used to be Altria's biggest supporter. I knew the CEO. I love it. And then, some things happen in your life, and you see people die. And you see people die, and it's connected to cigarettes, and then you decide, you know what? I can't take the money. I know that they don't care. I know if you buy it, it doesn't really matter. I can't live with myself having seen what happens. I'm going to have to take a pass on that question to other people who have a better answer. Let's go to Anthony in New York. Anthony.
Booyah, Jim. Thanks for taking the call. Love the show.
Of course. Thank you, buddy.
I wanted to ask you about Delta Airlines and how they.
I'm not recommending any airlines. I mean, if they couldn't make that money with the extremely full flight and the overhead, and you can't get in and move around, I can't get the seat. They take my seat by $100. If I don't buy the seat, you forget about it. How about Jake in South Carolina? Jake.
Hey, Mr. Cramer, college football player here. Just wanted to get your thoughts on Alphabet.
Oh, D1, D2? Are you D1? It's done? You talking about D1? I mean, a D1 player just called in. That's a big deal. All right, Alphabet, here's the problem with Alphabet. It's my least favorite of the Mag 7. Why? Because they don't run the company well. I like the fact that Jonathan Cantor wants to do one of these sum-of-the-parts situations. It's just that the problem is he's in the Justice Department. He's not an analyst. If he was a corporate finance guy, if Jonathan Cantor were a corporate finance guy, that stock would be double. All right, is that it? No, give me some more. Let's go to George in Massachusetts. George.
Hi, Jim. I bought stock in Ferrari when it was around $50 right after it came public. The stock is now around $450. Should I hold on to the stock? Or
George, do you really need me? Look what you did. You bought it 50. I mean, I'm sitting here nursing the stuff that I own, like some stocks that I'm down like 20% on. You know more than anybody. Take out your cost basis and let the rest run. But George, you're my co-host from now on. I'm getting rid of Cantor. Cantor was my co-host for a day. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer took your questions at today's monthly meeting. But he's not done yet. We hear more from you next.
today, we held our CNBC Investing Club monthly meeting. Once a month, my partner Jeff Marks and I get together to walk club members through the process of how we make decisions for the portfolio. We discuss our current holdings. And then we take questions from our club members. My favorite part of these meetings is taking your questions. And since we didn't have enough time earlier today to go through all of them, I'm going to give you an inside look at what we do for the club in tonight's show. Now, by the way, if you want to take a look at what you missed and you are already a member, the full video on demand will be at cnbc.com/investingclub/live. And if you like what you hear and you want to be part of next month's monthly meeting, scan this QR code or go to cnbc.com/join the club to become a member. I hope you do. First up, we have a question from Nick in Indiana who asks, I'm interested in your opinion on General Motors. It seems all signs have very, very positive under Mary Barra, but the stock hasn't been reflecting that to the level that I would expect. Also, am I wrong to think that the automotive industry will get a boost once rates begin to fall? Should I keep holding it? You are right. It's one of the biggest beneficiaries of lower rates because people buy cars on credit, so to speak, on time. And what you need to know is that GM is doing much better than Ford. GM has a big buyback. Mary Barra is doing a terrific job, and I like the stock very much. Inexpensive stock, good place to buy. Now, let's see a question from Martin, who asks, when is the time, if ever, to buy CrowdStrike? Last week, I called the bottom of CrowdStrike. I said it wouldn't go around below 230. I think it's going to be up from here, but I do like Palo Alto Networks more. That's the one that Trust owns, but I think George Kurtz is going to pull back. That other than Delta, I don't see a lot of people, companies leaving the world of CrowdStrike. It's a loved product. Next up, Glenn in California. Yes, both presidential candidates have said they want pharmaceutical companies to lower drug prices. How would this affect companies like Eli Lilly? Well, all I can tell you is that Eli Lilly has a GLP just one drug, and it's got so many different things that are helped by it, that all we need, if you own Eli Lilly stock, as my Travel Trust does, is to get approval from Medicaid and a couple healthcare companies, and there's nothing in health insurance, and neither president's going to be able to do anything about it. Now let's go to Gabe in Michigan, who asks, with strong earnings, free cash flow, guidance, and dividend, Devon appears to be a strong buy. What are your thoughts? I shared similar sentiments to club members. We own Coterra. It's good. I'm wondering whether Devon might be better. And why I say that is because Devon has made a series of acquisitions, giving yourself a lot more oil, and I think that Rick Moncrief's doing a good job. Next up, we have a question from James, who asks, what do we do with Dell Technologies? But right after earnings, just can't catch a bid. Okay, listen to me. It's Michael Dell. You will catch a bid. I think you should buy some now and buy some if it goes below 90. You'll get a better basis, and you'll be able to ride it up because that is the favorite partner of NVIDIA, and that's what matters. Now, let's go to Kim in Arizona, who asks, I know gold is at its highest level, but I would like to know if you recommend getting in at this point or wait for a pullback. Also, is it better to buy actual gold stocks, or an ETF? I like them all. Gold, you can go to Costco. Join up at Costco. Buy gold from them. Gold ETFs, very good. Agnico Eagle, best gold stock. They all work. Don't buy it all at once. You can buy the bullion now. Do not store it at your house. Store it at a bank deposit. Next up, we have a question from Jason in Pennsylvania, who asks, with Celsius dropping into the 30s, would this be a good time to buy? We had Mr. Fiedley on. I was not sure about the answers. I do feel that the energy drink category has slowed dramatically. I am concerned about that. I'm fear getting involved in a value trap because if they don't pick up the growth, you don't want to be there. Let's wait for a couple of months where the growth is better. Lastly, we have a question from Randy in Virginia, who wants to know, should I name my new puppy NVIDIA, or do you have a name that might suit him better in the long run? Long-time member, thank you. Look, I think that we've already had Amazon, a terrific pup. Okay, it was a great stray dog. I would name who I would name your dog right now? Oh, gee, there's NVIDIA, and that's Ragu. Ragu, and we also have Tony. We have Ragu and Ragatoni, okay? Here's who I think you should name your dog after. I think you should name your dog Starbucks in honor of Brian Nickel. It's kind of a good name. It's kind of like, from Melville. Anyway, thanks again to all our callers. Remember to join the club ahead of next month's meeting. I'd like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.